The market suffering its worst week of the year across the board today on the heels of disappointing jobs numbers. So where do we go from here? Joining me right now to talk about that, Heather Hughes from Sun American Funds will join us, along with John Spallanzani from GFI Group, Quinta Tatro from Tatro Capital, and Paul Dietrich from Fairfax Global Markets. Good to see everybody. Thanks very much for joining us.
Thank you. Thanks, Maria.
Let me kick it off with you, Paul. Thanks very much for being here on set. I want to ask you about this reversal today, down 170 at the worst, down 41 points at the close. Were you surprised? What do you think was behind this?
Well, obviously it was the jobs numbers that came up early on today. But we look at long-term trends, and every month they revise these numbers, and they're revised up. Right. And that's been the trend. And so I think investors really need to think, okay, we know these aren't the final numbers. Look at the long-term trends in job growth. They're positive.
So they ignored them. They ignored
and I think that's what you saw at the end of the day today.
John Spallanzani, sitting on that trading desk of yours, watching the trend switch gears from down to up late in the day. What were you thinking? And tell me what was behind it.
Well, it wasn't that much of a surprise. I mean, earlier this morning we saw the fact that Caterpillar was able to hold a bid, even though in a down tape. That was pretty positive. The second positive thing, I think, was the fact that the long bond was down, was up three points. The 10-year was down at 168. So the miss this morning on the employment report gave us quantitative easing today, in the sense that, in the fact that the bond market rallied so much, there was no other place to put your money once again. Are you going to buy 10s at 168? Are you going to buy 30s at 2.8? That money is now leading to many to believe, myself included, that we're going to see another wave of refinancing. The spread between 30s and 10s and the mortgage rate has been about 100 basis points. Right now, we have mortgage rates about 3.5%, the 10-year at 168. So if we put 100 basis points over that, mortgage rates really should be in the high twos, so anywhere between 2.5% to 3%. So at the end of the day, what we saw was everybody piling back into financials and home builders as well. Toll Brothers, a lot to buy on the close. We saw financials, a lot to buy on the close.
Yeah, isn't that really at the end of the day? Because at the end of the day, it's where are you going to put your money? I mean, it was today, it was this year, it was last year. I mean, this has been the story since October of 2012. Heather.
Yeah, so it's interesting. You brought up a good point. The key is focus going forward. Will investors direct their attention to the macroeconomic data and jobs? Or will they choose, maybe even earnings next week, to focus on cheap, easy money borrowing supplied by the Fed and that big leverage or big valuation differential between stocks and bonds, as the previous guest alluded to? If so, then the markets could still drift higher.
Yeah, well, I would imagine so, given what we've got going on with the Federal Reserve. I mean, that's really the point here. You don't really want to get in front of the Fed. So in terms of allocating capital today, how would you do it?
Well, we're looking strongly at U.S. industrials, especially in what we call the EMA, energy, manufacturing, and agriculture sectors. And also, we strongly believe that every portfolio ought to have 5 to 10% in gold, especially gold mining stocks that are.
I would have lost my money if I had my money in gold.
Yes, but you got to look at it as a hedge. I mean, today it did fine, or it was earlier today. Right. It's a hedge against all the things, North Korea, all the things you've been talking about all day.
Maria, I'd like to jump in here real quick if I can.
Yes, please.
It's fascinating to me that we're seeing increased volatility. The market got bid up again from the lows today, but we're seeing now these shock waves, and we're ultimately seeing the same thing play out that we've seen in the last 3 years. We've seen an incredible start to the year. The first 3 months, I come on the show, everybody gets all bullish, exciting, and then all of a sudden the market gives all of it back. And I think we're setting up for the same thing this year. And I think investors out there need to take a deep breath, take a step back. And what's wrong with, what I always struggle with people is, there's no other place to put your money. Well, if the pattern repeats itself, the best place to be right now is to be building a cash position, so that later on in the summer, when we get oversold, which we will, you can then buy that dip. I think we've seen the same thing play out the last 3 years. It'll happen this year.
Yeah, but I mean, with the Federal Reserve continuing this stimulus policy, let's say they don't end the stimulus policy anytime soon.
Well, I think they've already started to hint. I thought it was fascinating yesterday that they started to hint against that. They started to hint that they might end it this summer if the data was good. So you're right. Maybe with today's data, they don't end. It's just infinite quantitative easing. And in that case, you're right. We just will go up forever. But that isn't going to be the case. We're going to see shock waves to this.
John, jump in.
Well, I mean, the Bank of Japan, that was kind of a game changer, what they did. You know, the dollar yen is already up to 97.70. The fact that they're going to increase the amount of liquidity in their system by twice as much is huge. Obviously, the fact that the ECB is also a pedal to the metal. So you're fighting this wall of liquidity, and I don't think we could just assume that because of the last 2 years we had a swoon, we're going to have a swoon this year. You know, the Fed knows that we've had a swoon. So everybody who thinks they're going to taper quickly, they're not going to taper quickly. And unless we get 6 months to 9 months of 200,000 plus job growth, they're not going to do anything. So at the moment, it's steady as she goes. You know, we saw good action today in energy stocks, such as Cabot Oil and Gas. You said Ultra Petroleum, Neighbors. You know, you're looking at stocks like ExxonMobil and Chevron that have $300 billion market caps. But yet, the oil and gas revolution that's going on in the United States, some of the market caps on those stocks are $3 billion, $10 billion, $20 billion. So where are you going to get alpha in your portfolio? You have to go to those stocks.
Well,
so we saw a big rally in those stocks.
I'm just getting an email here, and I'm hearing that the last time quarterly earnings growth came in under 1%, okay, that was the second quarter of 2012, and that was growth of just under 0.9%, so it was below 1%. The following quarter, so the S&P 500 gained 5.8%. So go figure. It doesn't matter that we're going to get 0.6% growth in earnings for the first quarter, which of course begins next week. We're still looking at the Fed to drive the momentum in the market. So why am I going to fight the Fed? And I'm talking the U.S. I'm also talking
think
Japan.
that Caterpillar showed us that this morning, Maria.
Yep, that's right. And look at Cat right now.
I mean,
it's come all the way back.
Yeah.
Well, Maria, I think we're in a very, very dangerous environment. And when the Bank of Japan comes out and they're talking currency war, as we're seeing right now, we could have shock waves. And again, you're right. You can't just fight the Fed. But we've seen what happens in this market when they even ease off the pedal for just a few moments. The market gets crushed. And I think investors need to be aware of that. And when the market's parabolic is a good time to be raising cash and then buying when the fear sets in.
When I think that the Fed is going to take the foot off the pedal, that's when I'm going to go with your recommendation, and that is to buy gold. I don't know why you would buy gold right here, knowing that they've already told us 2015 is the date.
Yeah, but
I think the biggest surprise that's going to be is the fact that the Fed is going to taper and the market is going to scream higher, because everybody is expecting the market to go down when the Fed tapers, and that's not going to happen.
Oh, really?
How about if the market goes down and the Fed hasn't tapered? What happens when the market starts to slide and the Fed is still printing?
What do you think, Paul?
Yeah, I think gold is going to go up at that point. It has to. We're seeing quantitative easing all over the world. This is going to happen. But there are other things out there, like North Korea, like Iran. There's, you know, the possibility of some tsunami out there. And that's why you need 5 to 10%.
What does that mean for me this quarter?
But you want to be in, I think, gold mining producers who are profitable producers, not the exploration.
Did nothing as gold prices were going up. I'm just explaining this to you, because for a long time I watched gold go up and the gold companies do squat.
They're at historic lows, and people have been, I think, hurting profitable gold mining companies because of the gold mining exploration companies, which have been having problems. I mean, if you're a long-term gold buyer, these are the companies to buy right now. I mean, you're buying at capitulation prices.
Got to believe the valuation is there.
It is.
Got to agree with you on that, Paul. Good conversation. Really appreciate the vibrancy there and all your ideas. Thanks, everybody. We'll see you later. Have a fantastic weekend to you all.